The average credit score in the United States is 713. That's rated good by FICO's own classification. And at the same time, the average American household is carrying $105,000 in debt. Those two numbers coexist in the same country, among the same people right now. And the reason they can sit alongside each other without contradiction is that the credit score was never designed to prevent debt from accumulating. It was designed to help lenders decide who to extend it to. This video is about what your credit score is actually measuring, the 5 components, what each one is designed to evaluate, and why none of them tell you whether you're financially healthy. And at the end, there are 3 numbers that actually do answer that question. They don't appear on any credit report. The FICO model was developed in the late 1980s to solve a specific problem for lenders. Before standardized scoring, loan approvals were slow, inconsistent, and frequently dependent on the judgment of individual loan officers. The score replaced that process with a formula. One number that could tell a bank quickly and consistently how likely a borrower was to default. That's a useful tool. But it's a narrow one. It doesn't know what your savings balance looks like. It doesn't track whether your income covers your expenses. It doesn't know whether your net worth is positive or negative, growing or shrinking. It knows one thing. Based on how you've managed credit accounts over time, are you likely to meet your repayment obligations? Over the last 2 decades, that number shifted from a lender's instrument into something resembling a personal finance report card. Banks started surfacing it on app home screens. Credit monitoring services made it a daily metric. The implicit message settled in. A rising score means you're doing well. A high score means you're financially healthy. That framing isn't accurate. Not because the score is broken. It does exactly what it was designed to do. The problem is that the question most people are directing at it isn't the question it was built to answer. The score gives you the lender's verdict on your reliability as a borrower. Most people are using it to answer something different. Am I okay? Here's what the score is actually measuring. FICO breaks into 5 components. Payment history is the largest at 35%. It captures whether you've paid bills on time, how late any missed payments were, and how recently they occurred. Amounts owed accounts for 30%, and this is primarily credit utilization, the ratio of your current balances to your available credit limits. Length of credit history is 15%, weighted toward the age of your oldest and average accounts. New credit, recent applications and hard inquiries, makes up 10%. Credit mix, meaning whether your history includes both revolving accounts like cards and installment loans like auto loans, is the final 10%. Every one of those categories is measuring your relationship with debt, how you've managed it, how long you've maintained it, how much of your available borrowing capacity you're currently drawing on. There is no category for savings rate, no input for net worth, no component that measures what percentage of your income you're keeping versus what you're spending. The formula was built to answer a lender's question. That question is narrower than the one most people are asking of it. The utilization component is where the divergence becomes most visible. The general guidance for maximizing your score is to keep balances below 30% of your limit on each card, and ideally below 10% for the highest scores. Carrying a $900 balance on a $10,000 limit card scores well by that standard. At the current average credit card APR of 21%, that $900 balance costs $189 per year in interest. The score treats it as a signal of responsible credit management. Here's the thing. Paying off that card entirely and then closing it because you don't need it and don't want to manage it actively hurts your score. Your total available credit drops, utilization increases on other accounts, and your average account age may shorten. The score penalizes you for eliminating debt infrastructure you no longer want. Lenders don't benefit from you holding fewer accounts, and the score reflects that preference. None of this represents the score malfunctioning. It's doing exactly what it was calibrated to do. The issue is that the behaviors it rewards aren't always aligned with improving your financial position. A lender's ideal customer is someone who borrows reliably, pays consistently, and keeps accounts open for decades. That profile can coexist with very little wealth accumulation. Whether you're building net worth alongside your borrowing is not the lender's concern, so it doesn't appear in their formula. Consider a profile that isn't unusual, a FICO score of 758, solidly in the very good range. 3 credit cards with average balances of $3,847 each. Total card debt, $11,541. At 21% APR, the annual interest on that balance runs $2,423 per year. Savings balance, $1,100. This person has never missed a payment. By the score's measure, they're a reliable borrower, and that's an accurate assessment. But the score says nothing about the $2,423 flowing to interest every year, the $1,100 sitting between them and any significant unexpected expense, or the gap between what they earn and what they're keeping. The way I think about it, that $2,423 in annual interest isn't just a cost. It's the compounding that isn't happening somewhere else. If that same amount were directed into a diversified account returning 7% annually, the accumulated difference over 10 years is roughly $33,487. The score has no mechanism for that trade-off. It was never asked to. And this profile isn't an edge case. 47% of credit card holders carry a balance month to month. 61% of those people have been in card debt for over a year, up from 53% in late 2024. Together, Americans paid $160 billion in credit card interest in 2024 alone. Many of the people in that number check a good or very good score and feel reasonably okay about their financial picture. The score is giving them an accurate answer to the lender's question. It's just not the question they were asking. There are 3 numbers that give a more honest picture of financial position. None of them appear on a credit report. The first is net worth, total assets minus total liabilities. This tells you whether what you own exceeds what you owe, and by how much. For Americans under 35, the median sits around $39,040. For a significant portion of that group, it's negative. Liabilities exceed assets. The credit score doesn't reflect this. A 740 score with a negative net worth is entirely possible and not rare. The second is savings rate, the percentage of take-home income you're actually keeping each month, not gross salary. Take-home post-tax what reaches your account. The difference between a 3% savings rate and a 12% savings rate held consistently over a decade is not a minor variation in outcomes. It's the difference between 2 fundamentally different financial positions. Neither rate shows up anywhere in a FICO calculation. The third is debt-cost ratio, total annual interest payments divided by gross income. This is the number that tells you how much of your earning capacity is being redirected to service debt you already hold. At $2,423 in annual interest on a $58,000 income, that's 4.2%. At $6,000 on the same income, it's 10.3%. The ratio is a direct measure of financial drag. The credit score doesn't capture it. These 3 numbers aren't surfaced automatically anywhere. They require a few minutes and a calculator, but they're answering the question the score was never built to ask. The credit score tells you how the lending system sees you. These 3 tell you where you actually stand. The credit score has a real practical function. It affects mortgage rates, rental applications, auto loan terms, sometimes insurance premiums. Knowing your score and keeping it in reasonable shape is a sensible part of managing your financial life. But it was built by the lending industry to serve a lending decision. It measures whether you're a reliable person to extend credit to. That's a narrow job, and it's the only job it was designed to do. The question most people are actually asking when they check it is different. Am I making progress? Is what I'm doing working? Am I okay? The score can't answer that. Net worth, savings rate, and debt cost ratio can. The score is the lender's read on you. The other 3 are your read on yourself. If the debt cost side of this is where you want to go deeper, there's a video here on how minimum payment schedules actually play out over time. The same math from the repayment angle. Thanks for watching. I'll see you in the next one.